If you've saved $1 million for retirement, first off, congratulations. That's an incredible feat. And surprisingly, not a lot of people accomplish it. So kudos to you. But there's a problem that nobody talks about. $1 million doesn't come with a paycheck. There's no direct deposit or consistency or even guarantee that it lasts. So the question isn't, is $1 million enough to retire? It's actually, how do we turn that $1 million nest egg into a paycheck that you can live on? So today, I'm going to walk you through a simple, practical strategy we use with clients that do exactly that. Hi, I'm Jonathan Bednar, certified financial planner with Paradigm Wealth Partners, and we help people turn their savings into retirement they can actually enjoy with clarity and confidence. Let's break it down. So most people approach retirement like this. I've got $1 million. I'll just pull 4% per year. 4% is a great rule of thumb. It's been around for quite some time, been tested over the years. It's a great strategy to use to give you a little bit of guidance. That gives you about $40,000 a year if we assume the $1 million. It's not wrong, it's just incomplete, because it ignores the 5 big retirement risks: taxes, inflation, sequence of returns, longevity, and your behavior, like panic selling or overspending in retirement. So instead of just pulling from one big pot, we want to create something that feels more like a paycheck, provides some consistency. So here's the framework. We divide your money into 3 buckets, and each will have a specific job. The first bucket is cash and short-term income. This is 0 to 1 years. This is your paycheck bucket. So cash, money market, high-yield savings accounts. This bucket is where we're going to fund your monthly income. So if you needed $3,000 a month from your investment portfolio, this is where we're going to take it from. No market risk, no guessing. Most of my clients set up a specific day of the month that they're going to have this directly deposited into their account. We set that up and it turns on like clockwork, gets deposited to them. That's what we're trying to accomplish for you. The second bucket is your war chest. This is your backup paycheck. So this is high quality bonds, bond ladders. We use a lot of bond ladders at our firm. Conservative investments. And this is what allows you to keep your income consistent and constant during downturns and allows the rest of your account to grow over time. The third bucket, this is your growth engine, your long-term bucket. This is your stocks, your equities, your growth investments. This money isn't for today. It's for 10, 20 years down the road. And as it grows, so your income is able to keep up with inflation. We know $1 5 years from now is going to buy less than $1 today. So it's important that we have this growth engine invested in a way that will help keep up with future inflation. So how does this actually work in real life? Let's say you need $60,000 per year. $24,000 or $2,000 a month comes from Social Security. The remaining $36,000 or $3,000 a month comes from your investment portfolio. Again, we're turning your nest egg into a paycheck. So the first step in doing that is to multiply the $3,000 a month we need from your investment portfolio by 60 months. That's $180,000 a year. So we're going to put $36,000 into the first bucket, the cash bucket, the paycheck bucket. We're going to put $144,000 into bucket 2. This is your war chest. This together gives you a fully funded 5-year war chest. You pull your monthly income from bucket 1, the $36,000 in cash or high yield savings account, that will continue to pay you on your designated sequence that you've elected. The key here is when markets are good, you refill bucket 1 from your growth engine bucket. If the market is up 20%, great. Peel some of that off, move it to bucket 1, and you replenish your bucket. When markets are down, you refill your bucket from bucket 2. This is your war chest bucket, so we're going to tap into the second year there, and we're going to use that to continue to give us the steady income that you're used to. And that way you're never forced to sell stocks while you're down. Here's where most people run into trouble. They either stay aggressive too long and they panic during downturns, or they get too conservative and they run out of money long term. They don't have enough growth long term to combat inflation, or they don't have a plan at all. And I see a lot of people fall into this category. They don't have a strategy. They're just guessing every year on what they can spend, how to allocate their money, what's the next hot stock to buy, what their neighbor told them. There's no strategy on how do you turn your nest egg into a paycheck. That's where this strategy really comes together. We have a very systematic strategy so that as we have growth in the market or even market downturns, your retirement income continues so that you don't miss a beat. So the goal isn't just to withdraw money. The goal is to create consistency and confidence and a framework that you can stick with. The best retirement plan isn't about looking good on paper or looking good to your neighbor. It's one that you can actually follow even when the market gets uncomfortable. If you're within a few years of retirement or already retired, and you're trying to figure out how to turn your savings, your investments into a real paycheck, this is exactly what we help people do every day. I've put a link below where you can learn more about us and our firm, or you can schedule a time to have a conversation with us. If this was helpful, make sure to like and subscribe. I break down these retirement decisions in ways that are simple and practical and usable for people. Thanks for watching. Be confident in your retirement. Have a wonderful day.